This is the story of how a specific legal challenge from the Canadian government forced a multi-billion-dollar shift in Fairfax Financial's capital allocation. While Prem Watsa has long been compared to Warren Buffett for his value investing approach, a significant dispute with the Canada Revenue Agency regarding the taxation of equity swaps altered the company's internal calculus. The ruling centered on how gains from these financial instruments were classified, distinguishing between capital gains and business income. This distinction is not merely an accounting detail, it represents a fundamental change in how large-scale investment firms must structure their Canadian portfolios to remain efficient. The outcome of this case signaled a quiet but profound transformation in the way Fairfax manages its massive cash reserves. For decades, Fairfax Financial Holdings, headquartered in Toronto, operated as a diversified financial services holding company with a core focus on property and casualty insurance. The engine of its growth was the float, the pool of premiums collected before claims are paid, which Prem Watsa invested with a contrarian long-term mindset. However, the legal environment regarding the characterization of investment income became increasingly volatile as the Canada Revenue Agency, or CRA, began auditing the use of total return swaps and other derivative instruments. These instruments allowed Fairfax to participate in the price movements of stocks without possessing the legal title to the underlying shares. Under the previous understanding, many of these transactions were treated as capital property, meaning only half of the gains were subject to taxation. The CRA's successful argument that these gains constituted full business income fundamentally shifted the net present value of Fairfax's Canadian investment strategy. The mechanism behind this shift involves the complex intersection of insurance accounting and tax law. When an insurance company like Fairfax earns a profit on its investments, that profit is used to bolster its regulatory capital, allowing it to write more insurance business. When a court rules that a significant portion of those profits must be redirected to the Treasury as tax, the compounding effect of that capital is permanently blunted. In the specific litigation involving Fairfax, the focus was on whether the company was carrying on a business through its high-frequency use of total return swaps. The court examined the intent, the frequency of transactions, and the relationship between these swaps and the core insurance operations. The finding that these swaps were integral to the business operations meant that Fairfax could no longer claim the 50% tax inclusion rate reserved for passive capital gains. This created a massive retroactive and prospective tax liability that forced a reorganization of how the firm deploys its float. Economic forces are rarely the result of a single event, but the conclusion of this tax dispute acted as a catalyst for Fairfax to move away from synthetic equity exposure and toward the direct acquisition of whole companies. This transition from being a synthetic investor to a brick-and-mortar owner changed the very DNA of the company's balance sheet. As this legal precedent solidified, the hidden mechanics of Fairfax's capital allocation began to mirror the strategies of private equity firms rather than hedge funds. By acquiring controlling interests in companies like Recipe Unlimited, BlackBerry, and various international subsidiaries, Fairfax ensured that its income streams were classified as dividends or consolidated business earnings, which often carry different tax treatments than derivative gains. This was a strategic retreat from the complexity of the 2000s and early 2010s, where Fairfax was known for massive bets on credit default swaps and equity hedges. The institutional pressure from the CRA forced a simplification of the portfolio. This simplification was not just about tax compliance, it was about capital efficiency. In a world where the CRA views active trading as business income, a firm with the scale of Fairfax must behave more like an operator and less like a trader to protect its margins. The move toward permanent capital, investing in businesses that Fairfax intends to hold for decades, was the logical response to a regulatory environment that became hostile to sophisticated financial engineering. This shift represents a broader institutional realization that the tax code is as much a factor in investment returns as market volatility or interest rates. The global context of this ruling reflects a synchronized effort by OECD nations to close gaps in how financial derivatives are taxed. While the Fairfax case was a Canadian phenomenon, it paralleled similar moves in the United States under the IRS and in the United Kingdom under the HMRC. These tax authorities began to view the Buffett model of insurance-led investing through a more critical lens, particularly when it involved derivatives that appear to mimic business activities. Other global markets took note of how Fairfax adjusted its strategy, moving capital into jurisdictions with more favorable or at least more predictable tax treatments for insurance float. This led to Fairfax expanding its footprint in India and other emerging markets, where the investment rules were more clearly defined in favor of the insurer. The Canadian ruling essentially exported Fairfax's capital to other regions, where the tax drag on equity investments was lower. This highlights a critical reality in modern finance. Capital is highly mobile and will flee to environments where the rules of engagement are stable. For Canada, the victory in court against Fairfax may have resulted in a one-time tax windfall, but it also resulted in a long-term shift in where one of its largest financial institutions chooses to deploy its next $1 billion of risk capital. The real-world impact of this shift is felt in the stability of Fairfax's share price and its credit ratings. By moving toward a model of owning whole businesses, Fairfax reduced the mark-to-market volatility that had plagued its earnings reports for years. When a company relies on swaps and hedges, its quarterly earnings are at the mercy of short-term market swings, which are then taxed at high rates if they are successful. By owning subsidiaries outright, Fairfax can report consolidated earnings that are far more predictable. This has led to a re-rating of the stock by analysts who previously found the company's black box of derivatives too difficult to value. The under-discussed shift here is the professionalization and institutionalization of the WATSA strategy. It is no longer about the star picker making macro bets. It is about a disciplined corporate structure that manages a diverse portfolio of cash-generating businesses. This evolution was accelerated, if not mandated, by the Canadian tax authorities' refusal to allow the old way of doing business to continue. It serves as a case study for how the invisible hand of the law can be just as influential as the invisible hand of the market in shaping the destiny of a multi-billion-dollar corporation. The final implications of the Fairfax ruling suggest that the era of the unstructured investment holding company is coming to an end. As transparency requirements increase and tax authorities utilize more sophisticated data analytics to track transaction frequency, other firms will be forced to follow the Fairfax lead. The transition from a focus on gains to a focus on earnings is a fundamental pivot for any capital allocator. For Fairfax, this meant embracing a future as a global conglomerate that looks more like a traditional industrial holding company than a nimble investment vehicle. This shift has arguably made the company more resilient to the next financial crisis, as it is no longer reliant on the liquidity of derivative markets to prove its value. Instead, its value is anchored in the daily operations of its subsidiaries, from restaurants to insurance providers to technology firms. This is the new reality for Fairfax Financial, a strategy defined not just by what it wants to buy, but by how the government intends to tax it. The quiet transformation of the company's capital allocation strategy is a testament to the power of regulatory pressure to forge a more robust, albeit more traditional, corporate giant.